Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Welcome to the Global View on this Thursday. Let's take a look at what's going on at a macro level. Inflation in the UK easing more than expected in June. The rate of inflation was at its slowest in a year at 7.9%, while core inflation, which excludes food, energy and alcohol, fell to 6.9%. The reading saw the British pound tumble against the greenback as the data lessens the likelihood that the Bank of England will need to keep raising interest rates aggressively. The US dollar bounced higher with the Aussie trading down at 67.7 it is now at the moment. Well, US data showed that home building fell in June, but permits for future construction rose to a 12-month high as a severe shortage of previously owned houses for sale supports new construction. And that data saw the US Treasury yields fall, with the 10-year down to 3.74%. The 2-year, little move there at 4.76%. Well, growth in the Eurozone has fallen sharply in recent months, so what lies ahead for the bloc? Well, earlier I caught up with Mathieu Savory from BCA Research.
Well, the state of the Eurozone economy at this point in time is actually quite poor. By many metrics, the Eurozone is in fact already in recession. The first quarter of the year and the last quarter of 2022 posted contraction in GDP growth. And when we look at economic surprises, they're extremely depressed. In absolute term, they're at their lowest level since the worst of the pandemic, and before that, the great financial crisis. And the same is true when you compare to the United States, where relative surprises have completely collapsed to near record low levels. So very poor state of the European economy at the current juncture.
Given that, what is your expectation for the second half of the year?
I'm anticipating a bit of an improvement in growth condition in the Eurozone in the second half of the year. To be clear, I'm not expecting a boom. So there is a variety of positive forces and negative forces that kind of counterbalance each other, but that do point to an improvement in growth. The first factor that's positive is that in the US, we did see an earlier decline to inflation than in the Eurozone. And as inflation declined, real wages started to improve, they're expanding, and this was very positive for consumption. And I expect a bit of a repeat in the Eurozone. We've started to see inflation slow. We anticipate further slowdown in inflation as the pass-through from energy ebbs, and that will have a very positive impact on consumption in the Eurozone because it will boost real wages. Another positive is that there's quite a bit of pent-up demand for durable goods in the Eurozone. If you look at real consumption of durable goods, it's roughly 12% below its pre-pandemic trend, while in the US it is 12% above. So as real wages increase, we expect some of that pent-up demand to be satiated. Specifically, when we look at auto sales, we do see a lot of room for auto sales to pick up, which is very positive for the European industrial cycle. The last element is related to the global industrial cycle. So here what we're starting to see signs of improvement. There's been a big adjustment in global inventories. We've seen foreign orders in China, in Japan starting to pick up, some improvement in Sweden as well. And this is happening in a context where many measures of global financial conditions have eased. And this is associated with a pickup in industrial activity globally and in the Eurozone as well. In fact, our nowcast of global industrial activity is turning the corner. So that would be very positive for the Eurozone because the Eurozone is much more exposed to the industrial cycle than the US. That's the positive. There are two negatives. The first negative is China. China is probably in a process of bottoming, but growth there is likely to remain weak. And Europe is very exposed to China. The second one is the monetary policy in the Eurozone. Policy is very, very tight. That has caused credit flows, money flows to decelerate very sharply in Europe, and this is associated with growth that historically remains tepid. So when we take the plus and the negative together, we arrive with a small improvement in growth, a pickup in surprises, but not a boom in economic activity in the Eurozone.
Mathieu, are you seeing, if we drill down a little further as to what's going on with those individual economies within the Eurozone, are you seeing much divergence there for some of the, particularly the larger economies?
Yeah, right now the most poor economy in the sense of its state right now is Germany, which is quite interesting because historically Germany is considered the locomotive of Europe. But it actually makes sense. Germany is by far the economy that is the most exposed to the weakness in the global industrial cycle. Roughly 22% of the gross value added of the German economy comes from the industrial sector. So it's much higher than the rest of Europe. Additionally, Germany was particularly hard hit by the energy crisis, since a very large proportion of its energy needs are fulfilled by natural gas prices. Now, the star economy, if you will, in the Eurozone at this point in time is Spain. Spain is doing very well. It avoided the contraction in economic activity in both Q4 of 2022 and Q1 of 2023. And the main reason behind the resilience of the Spanish economy is that inflation in Spain is a lot lower than in the rest of the Eurozone. Today, it's around 1.9%. So this means that real wages in Spain are growing in positive territory, unlike the rest of the Eurozone. Real retail sales volume are positive. And there is an added benefit for Spain, which is that tourism is very, very strong. In May, they took 8.2 million tourists, which is a record high for the month of May, even compared to pre-pandemic environment. So the Spanish economy is definitely the one that is outperforming at this point in time.
Mathieu, are you also factoring in geopolitical risks ahead? Clearly, with the war ongoing in the east, in Ukraine, what are the risks associated with that at this point, do you think?
Well, the big risk here is that the conflict drags on much longer than expected, and that Russia starts to curtail even further some of its energy exports. Now, you can tell me, yeah, but energy exports from Russia to Europe are minimal right now. It's true, but if you look, for example, at Azeri gas export to the Eurozone, they've increased tremendously, while at the same time, Azeri import of Russian natural gas have actually increased in proportional quantities. So you can do the math, what's going on in the background. So there is always a risk here that Russia curtail its shipment of gas to some countries that historically have played a role of a vector in between Europe and the Russians. And that would cause a little bit of problem from this perspective for the European economy. But overall, we're still in a much better position than we were last year, due to the fact that European nat gas prices remain competitive globally. So LNG flows from the United States remain ample. The Europeans have very large stocks of natural gas at this point in time, and we've seen shifts in consumption patterns away from natural gas since the crisis started, which make Europe more resilient to other actions from the Russians.
And of course, most recently this week, we have had that deal allowing from Russia, allowing Ukrainian grain to be exported through the Black Sea. That deal has now collapsed. Do you see any significant impact from that?
It's going to be a problem for global markets, especially emerging markets that have depended on exports from the region. But from the perspective of Europe, Europe still has access to Ukrainian wheat and other agricultural resources via land transfer, so mostly train and things like that. So from the perspective of Europe, it's not a major risk, but for emerging markets that are dependent on foreign food imports, so especially countries like Egypt come to mind here, this is potentially a source of risk, especially with the very hot summer that we are witnessing around the world, very dry also in many places, that could add more trouble to wheat harvests later this summer.
So Matthew, given you what you just outlined, particularly as far as the macro, at the macro level there, how are you looking now at equities in the Eurozone and their room, I guess, for growth, those current valuations that you're seeing there?
So in the near term, we're likely to see a bit of an outperformance of Europe relative to the United States. Over the last 6 years, there's a pretty robust correlation, in fact, between economic surprises in Europe relative to the United States and the performance of the Euro stocks vis-a-vis the S&P 500. And as we witness the European economic surprises collapse relative to the United States this year, we also saw the previous outperformance of European stock vis-a-vis the US, so what that took place from the mid of 2022 until the beginning of this year, being halved. So if we are seeing an improvement in European economic surprises, we should see an improvement in European stocks as well. Moreover, European stocks are very exposed to the global industrial cycle due to their sectoral weightings. And if the global industrial cycle is starting to stabilize and is not in free fall anymore as it has been for more than 12 months now, this should give a bit of an additional tailwind to European stocks. However, looking beyond that, so beyond the next 3 to 6 months, the outlook is a bit murky because one of the dominant driver of the performance of US stocks has been the bubble in AI and AI related plays. This bubble actually has room to expand. It doesn't mean that it's rational, but it's kind of historical bubble dynamics. They can continue quite a bit longer than what we've seen so far. And Europe doesn't have nearly as many AI plays as the United States. So if the AI bubble regain tractions, then European equities are likely to underperform. That's more a question mark at this point in time. I think what we can more bank on is over the course of the next 3 to 6 months, European stocks have room to outperform.
Mathieu Savory from BCA Research. All right, that is the global view for this Thursday. Stay with us. The open's just around the corner. We are expecting a flat open. Stay with us. Nadine will be with us in a moment.